have land, buildings. These are typical examples of property, plant, and equipment. Then we talked about land improvement. Do you remember what land improvements are? Yeah. So Liang says it's a fence. It's everything which is which sits on a land and which kind of like improves the land. So it could be a fence, it could be a sign, it could be a driveway. Yeah, whatever. Yeah, good. And it is it belongs, of course, to the land, but it is on the balance sheet is separate, and it is separate because it is different. It has to be depreciated. If you think about it, a fence has to be depreciated because it loses value over time. Yeah, from time to time you have to renew the fence and build a new fence, and so that's why you should have to depreciate it. Whereas land in general does not have to be depreciated because land doesn't have a useful life. Yeah, so land rather has an indefinite life. There's no point in time in the future where you have to renew the land or anything like that. Yeah. So land doesn't have to be depreciated. All other things that are shown here have a useful life, and that's why they have to be depreciated. Can you do you remember what depreciation means? What is a depreciation? What does that mean? Land or a building has to be depreciated. Exactly. Yeah, the price decreases because of time. This is what Liang says. The price, the price, or rather the book value, what is stated on the balance sheet, the book value, the value decreases because of time. Yeah, because after the life of the asset, essentially the asset is useless and doesn't have a value at all, or only has a very minor value, and that's why we will have to depreciate it over time. Yeah. Generally, property, plant, and equipment is expected to be used for more than 1 year. Yeah, it's expected to be used for more than 1 year. So it's a long-term asset. Yeah, it's a long-term asset. By the way, can you see the slides on your screen? Okay. When we're talking about a property, plant, and equipment, a company has to choose between the cost model and the revaluation model. Between the cost model and the revaluation model. And the cost model, this is more prevalent. Yeah. So most companies, 90% of the companies, they use the cost model. And when they pick one of these models, the cost model or the revaluation model, they have to apply this model to the entire class of property, plant, and equipment. Yeah. So that's so there is no cherry picking. Yeah. No cherry picking. You say you cannot say for this asset I use the cost model, and for the other asset I use the revaluation model. Yeah. So you have to choose once, and then you have to apply method to the entire class of property, plant, and equipment. And generally, the difference between the cost model and the revaluation model is that the cost model, you put the assets, you value the asset with the cost, and then you depreciate it over time. Yeah, you depreciate it over time. That's the cost model. Yeah, you can also use a different depreciation method, but this is a different thing. Yeah, so this is the cost model, and the revaluation model is different. Yeah, the revaluation model. Revaluation model. Initially, you also take the cost, but then subsequently, when you also depreciate it, of course, but then when you see that the value changes, the fair value changes, let's say it goes up, yeah, you take that value, yeah, you take the higher value, and that's why it's called the revaluation method. Yeah, so the value you take the fair value. Yeah, and the fair value can be the market value, yeah, of this asset. So this is the big difference between the cost model on the left hand side and the revaluation model. And generally, an item of property, plant, and equipment can be capitalized if it fulfills the following criteria. And first of all, what does capitalized mean? Any idea? Any idea? What does capitalized mean? Get the money and let the money make more money. Essentially, in this context, it means something. It means something that else. In this context, it means put it on the balance sheet. Yeah, when you capitalize an asset, you put it on the balance sheet and depreciate it over time. Yeah, that's the nature of capitalizing. You put it on the balance sheet as an asset, and then you depreciate it over time. The opposite is you expense something. If you expense something, then it goes right into the income statement. Yeah, and it goes right into the income statement. If you capitalize something, you put it on the balance sheet, and it is not expensed right away if you capitalize something. Rather, the expense, the related expense, is the depreciation. Yeah, and the depreciation resembles the loss in value over time. Yeah, so you can capitalize an asset, property, plant, and equipment. You can put it on the balance sheet if there are future economic benefits. If there are future economic benefits. And the costs can be measured reliably. If there are future economic benefits and the cost can be measured reliably. Yeah, so if these two criteria are met, then you can put an asset on the balance sheet in a property, plant, and equipment. When we're talking about subsequent costs is the costs that follow after putting the asset on the balance sheet. Then we have to differentiate between day-to-day servicing costs and costs that extends the asset's usefulness. Yeah, so day-to-day servicing are not capitalized. Yeah, so this is just normal repair. This is not capitalized, but rather it's expensed. Yeah, it's not capitalized, but expensed. And on the other hand, costs that extend the asset's usefulness or useful life. So these costs make the asset more valuable. Yeah, the asset becomes more valuable. And these costs, they are put on the balance sheet. They are capitalized. Yeah. So this is the difference. Yeah. Does that make sense? Yeah. So if an asset becomes more valuable, yeah, then you put that additional cost on the balance sheet. So it increases the value of the asset. If it's just normal repairs and day-to-day servicing, then you are not allowed to capitalize it. You are not allowed to put that cost on the balance sheet, but rather it goes through the income statement and it's an expense. Yeah, it's just an expense. It's expensed right away. Okay. So here we see how to measure recognize an asset. And here we differentiate between acquired assets. This is acquired assets when we purchase an asset, and self-constructed asset. Yeah, when we construct the asset ourselves. Yeah. So when we acquire an asset, like say a machine, yeah, a building, something like that, then we put on the balance sheet the purchase price, yeah, which is the most important element, including non-refundable taxes deducted by discounts and rebates. Yeah, so essentially this is, we put it on the balance sheet with the purchase price. Yeah, of course, when we get a rebate, we have to deduct it. Yeah, and we also put on the balance sheet costs that are directly attributable. Yeah, so this is, for example, the costs of site preparation. Yeah, costs of site preparation. When we prepare a site, yeah, initial delivery and handling costs, installation and assembly costs, costs of testing, and professional fees. Yeah, so these are costs which are said to be directly attributable to the asset. Yeah, so that's why we also put them on the balance sheet. Yeah, so this is for acquired assets. This is for acquired assets, and acquired asset means bought asset, purchased asset. Yeah, on the right hand side, we have self-constructed assets. Yeah, self-constructed assets means we build the assets ourselves. Yeah, and let's say, for example, BMW builds a car, but it doesn't sell, but it uses the car for its employees. Yeah, then BMW has built the asset itself. Yeah, so the question is, what elements have to be included when we're talking about self-constructed assets. Yeah, and one important element is material and labor costs. Yeah, so material and labor costs have to be put on the balance sheet. Then the next is production overhead. Do you have an idea what overhead is? What is overhead? Any idea? What does overhead mean? No? Overhead costs. Exactly, yeah. It can be management. That is, Ray-Chan, this is correct. Overhead is management. But then it's called general overhead. Yeah. Overhead costs are charge of water. Exactly. So it's overhead costs are costs not directly attributable. Yeah, so these are costs that are not directly attributable to one single product in the product. Exactly. Yeah, so it could be production, when we are talking about production overhead, and we are talking about here, this is production overhead. Yeah, so production overhead. Here, this is not the salary of the CEO. Yeah, the salary of the CEO is general overhead. Yeah, it's general or administrative overhead. Production overhead could be something like the energy usage of a machine, yeah, or charge of water. Yeah, Liang, you're right. If you use water for any for a production process, this would be a production overhead. You are allowed to put production overhead on the balance sheet, yeah, but not administrative overhead, yeah, not at administrative overhead. Administrative overhead. Yeah. So this is not allowed, not administrative overhead. So you are not allowed to put the salary of the CEO here, yeah, but the energy usage of the machine, yeah. For both acquired, so this is for both acquired and constructed assets. We take the financing costs on the balance sheet and initial estimate of the cost of dismantling and removing the site. Yeah, so this is also, yeah. But what is not allowed, so this is not what is not allowed, cost of opening a new facility, cost of introducing a new product, cost of relocating business, including staff training. So staff training, you're not allowed to put the staff training on your balance sheet, yeah, because you say this staff training belongs to one certain product. This is not allowed. So this is not allowed. Or also administrative and other general overhead. So this is the CEO, for example. Yeah, CEO is not allowed. Yeah, and you can put financing costs on the back. What is financing cost? What do you mean by financing costs? You have an idea? The cost in investment, exactly. When you invest, you have to incur costs, and basically what that is, financing costs. Basically, what that is interest. Yeah, cost in financial markets. Yeah, but basically, this is the interest you have to incur. Yeah. No, it's not so, Ray Chan, it's not so much about a stock up and down. What we mean here by financing cost is when you finance an asset with debt, you have to incur interest. Yeah, so it doesn't have to it's not about stock price volatility or fluctuations in stock prices. What is meant here by financing costs according to IAS 23? This is interest expense. Yeah, so this is interest expense. So generally we have to take, as we have seen, we have to take the purchasing price. Yeah, generally we have to take the purchasing price as an initial value to put on the balance sheet. But if we acquire an asset in a non-monetary exchange, yeah, in a non-monetary exchange. So this is non-monetary exchange. Then we do not have a purchasing price. Yeah, non-monetary exchange. So there is no price, no cash price at least. Yeah, when we have a non-monetary, there is no cash price, and that's why we measure it at fair value. Yeah, so we measure it at fair value, whatever fair value means. Yeah, unless the exchange transaction lacks commercial substance. Yeah, unless when the transaction lacks commercial substance, then it's not measured at fair value, and the fair value of neither the asset received nor the asset given is reliably measurable. Well, so when we cannot measure it, we do not take fair value. Yeah, of course. Yeah, but generally in a non-monetary exchange, non-monetary exchange means this is a barter. Yeah, barter. When we kind of like we swap one asset against another asset. Swap assets. Yeah. Ray Chan asks, how do we know the fair value in the market? This is a very good question. Yeah, so this is a very good question. And sometimes it's not that easy. Sometimes it's not that easy. You can have an expert, for example, or you can also, if you swap assets and maybe you have the price, the value of the other assets. Yeah, and you take the value of the given asset. Yeah, because generally you can assume that the value of the given asset and the value of the received asset, the value is the same. Yeah, because otherwise you wouldn't swap them. Yeah. Yeah, it can be a market value. Sometimes you might have a market value. You have an expert opinion. Or you could also use this discounted cash flow valuation. Yeah, so you look at the assets and you basically you estimate all the future assets, all the future cash flows that this asset generates, and then you discount these cash flows to the present. Yeah, so this could this would be an approach to get a fair value. Yeah. So, but the question is very good, and sometimes there is no easy way to find a fair value. Is this the answer to your question, Raychan? All right. Then we can continue. So when we are talking about the cost model, so remember there is the cost model and there's the revaluation model. Yeah, so this is the cost model. Here we are not talking about the revaluation model, but rather we are talking about the cost model. And in the cost model, we recognize an asset with cost less accumulated depreciation. Cost less accumulated depreciation. This is the book value. Yeah, the book value. The book value is the value stated on the balance sheet. Yeah. And less accumulated impairment costs. Yeah. When we have an impairment, we also have to reduce the book value by the amount of that impairment. We will come later to what is an impairment. Yeah, we will come later to what is an impairment. Very generally, it is when the value loses when the asset loses in value, then you have to write it down. That's basically very basically that's an impairment. Yeah, but we will come to it later in more detail. So generally, you recognize an asset at cost. Yeah. Initially, you recognize the asset at cost. Yeah, so this is cost. This is cost, and then less accumulated depreciation. Yeah, so this is the depreciation, and let's say we are here. Yeah, then this is our, let's say this is year 1, 2, 3, 4. This is year 4. This is time. So then this is the book value here. Yeah, it's cost less accumulated depreciation. And depreciation is the allocation of costs over the useful life. Yeah, allocation of costs over the useful life. And we have several different depreciation methods. We have several depreciation methods. We have the straight line method. Yeah, so this is the straight line method. This is the straight line. Here, you see that? So the value decreases every year, decreases by the same amount. Yeah, so this is straight. This is why it says straight. This is straight line method. And when we accelerate depreciation, yeah, rate depreciation. The rate depreciation, it kind of looks like this. So percent of the book value, then the absolute amount becomes lower with every year, because your book value decreases. Yeah. So this is the accelerated depreciation method, and but most firms use the straight line. So the straight line is much more frequent than the accelerated depreciation method. If firms use the depreciation method, it's mostly for tax purposes, yeah, because firms want to save taxes, and that's why they use the accelerated depreciation method. Because especially at the beginning, in earlier years, yeah, so let's say this is year one, the expenses are higher, and if you have higher expenses, you have a lower income and lower tax base essentially, and you can save taxes by using the accelerated depreciation method. So sometimes firms use it because of tax reasons. And then the third method is the units. The third method is the units of production method, and the units of production method is means the depreciation is not based on time, but it's rather based on the usage of the asset. Yeah. So let's say the first year you use it a lot, the asset. In the second year, you use it only a little bit. Yeah. Then the depreciation is much lower, and in the third year again, you use it a lot. Yeah. So then here with the units of production method, the depreciation really, the amount of depreciation really depends on the usage of the asset. Yeah. When you use it a lot, you depreciate it a lot. When you use it not a lot, then the depreciation is also much lower. Yeah. Yeah. Does that make sense, or are there any questions related to this slide? Clear? Okay. And then if there are no questions, then we go on. When we talk about depreciation, we have to talk about depreciable amount. The depreciable amount is the amount you have to depreciate. Yeah, so depreciable amount is the amount you have to depreciate, and it's determined. Yeah, it's determined after deducting its residual value. Yeah, so you have to deduct the residual value. Do you have an idea what is residual value? Do you have an idea? Yeah, Liang, cannot be depreciated anymore. That's correct. Yeah, cannot be depreciated anymore, because then it's essentially the amount you get at the end. Yeah, when you sell the amount, the asset. So it's kind of like the salvage value. Yeah. Yeah. The residual value is the value at the end. Value at the end. At the end of the useful life. Yeah, also called salvage value. So a straight line method. We already talked about the straight line method. Straight line means equal amount. Yeah, so the same amount every year, equal amount. So this is in every year. Has to be year. Sorry for that. A year in every year or period. And this is how you this equation here shows how you determine, how you calculate the depreciation per year when you use straight line depreciation. What is the depreciation per year? And basically what you do is you take the cost, and from the cost you deduct the residual value. From the cost you deduct this residual value, and then you divide it by the number of years. Yeah, you divide it by the number of years, and then you get to the depreciation expense per year. So the second method is the accelerated depreciation method. So the accelerated depreciation method, it depreciates a larger amount at the start, at the beginning. Yeah, so at the start it's a higher amount, and so when we have this, and this is money, the value, and this is time. Yeah, so then the accelerated method depreciates a larger amount at the start, and then in later years it's lower. Yeah, so this is let's say this is 1 year. So we have a bigger amount here than, let's say, in a later year. we only have this. Yeah, so in later year, the depreciation amount is lower. Yeah. And this is often used for tax purposes, because in the early years you have higher expenses here. Yeah, higher expenses, and higher expenses lead to lower tax burden. So some firms, if they have the choice, if they can choose this one, they choose this one because of tax reasons. Are there any questions? Then we go on. We have the third depreciation. We have the third depreciation method, and the third depreciation method is units of production method. Sorry. Liang, what do you mean by will depreciation rate change? If it is 15% in the first year, next year it's still 15%. Yes. 15%. The percentage is constant, but the absolute amount changes. Yeah. So think about it. This depreciation rate stays the same. So let's say this is 15%. Yeah. Then it stays at 15%. So it's 15% in the first year, it's 15% in the second year, it's for 15% in the third year. Yeah. But the book value goes down from year to year, because the book value is what is written on the books, and the book value is decreased by the depreciation. So this is only here. This is only for this accelerated depreciation method, and for the accelerated depreciation model, the method, the depreciation rate stays the same. Yeah, it's 15% or it's 20%, but it won't change. It stays the same. Yeah, but the depreciation per year, it goes down. Why? Because the book value gets down. Yeah. So think about it. If this is your asset value, yeah. If this is your asset value, and this is the time, yeah, then this is the book value at the beginning. Yeah. So it's cost, and then this is here the book value in year one, after year one. This is the book value in year two. So the book value decreases. This is the book value in year three, whatever. Yeah. So book value decreases, and when you have a decreasing book value and you multiply it by a constant depreciation rate, your depreciation per year gets down. So is it clear now? Okay. Good. But it's good. It's good when you ask. So do not hesitate to ask. It's good. If you have questions, just ask. And this is the units of production method, and the units of production method is different because the units of production method, it's not useful life or number of years, but here it's units of production or units of output, yeah, that determine how much is depreciated. Yeah, so it's units of production or units of output, not years, yeah, or period or something like that. So it's not the time that determines how much you have to depreciate, but it's how much you use the asset. That's why it's called units of production method. How much you use it, or how much is your output. So here your depreciation will depend on how much you use it. So let's say you have an oil well, yeah, an oil well, oil or an oil field, and you use it a lot because you extract a lot of oil, then it is depreciated by a higher percentage or a higher amount. And when you use it only a little, then it's depreciated by a lower amount. Yeah, but we will have an example later, and then it will be very clear, I think. So, but now I would say let's have a break. Let's have a break.